Well, listen, I think we have to have some perspective. We had a really good year so far heading into September. We're having another gut check. It almost feels like deja vu with this ISM number. Last month there was a sell-off in the beginning of the month, and then we rose 3.5. So I think right now, I think we have to recognize there's a difference between a slowdown and recession. We're still not in the recession camp. And also, even though there's been so much focus just on the U.S., something important happened in the global PMIs yesterday. That is, they rose from the previous month. The second month in a row they've risen after a streak of 15 straight months down. So I think we're seeing some stabilization. Sentiment is getting reset right now. And eventually, as we move past this, we still think that as we move towards the end of the year, we could still see upside as folks are so de-risked right now already that any good news could go a long way in helping this market towards new highs.
Yeah, Tobias, that's the thesis that's running out there, that ISM may be bottoming. You get some stabilization in the global PMIs. We'll find out tomorrow and Friday if this is truly bleeding to services and the consumer. What do you think?
So, Carl, a number of things. Let's start with sentiment. Keith noted it's weak. Our panic euphoria model, our kind of proprietary sentiment metric, it's not in panic, but it's near panic territory, yielding about a 95% probability of markets being higher a year from now. Number two, CNI, or Commercial and Industrial Lending Standard from the Federal Reserve Board, is a 9-month lead indicator on economic data. I kind of don't like to respond to an ISM number that just showed up. We kind of saw this early this year when we saw tightening credit conditions. 9 months later, we were going to have problems. We're in September, 9 months later. Not a big surprise. But the data actually improved in April and stabilized again in August, which suggests we're likely to see some improved economic conditions here in the U.S. in the fourth quarter into the beginning of next year. And that's not in the current mindset. So that would be supportive of markets, of earnings, et cetera. And I would say the third thing is we just completed a survey of institutional investors, and they're really fascinatingly shifting from being defensive and kind of growth-oriented to more value and cyclicals for 2020 in terms of their sector preferences. So investors may not be there yet, but they do see a different view for 2020.